Hello, Doug Mitchell here with Ogletree Financial. Today, we're going to be diving into a powerful financial strategy that's really gaining attention among savvy investors and retirement planners all over the country. And it's called the Max-Funded IUL, or Max-Funded Indexed Universal Life Insurance Policy. So this approach not only provides life insurance protection, but also significant potential for tax advantaged growth and tax free retirement income. So let's explore how max funded IUL works and how it could be a valuable addition to your current retirement strategy. A max funded IUL is designed to maximize the cash value component of an indexed universal life insurance policy by contributing premiums well above the minimum required premium without exceeding the MET limits. You can greatly accelerate your policy's cash value accumulation. This strategy ties your policy's growth to market indices like the S&P 500 and other carrier-specific index allocations like the Fidelity or the Bloomberg, the PIMCO, all while keeping your principal protected from a market downturn. So in a max funded IUL, the policy is structured with a minimal death benefit, and that's to reduce the insurance costs. And that frees up more of your dollars to grow your cash value. If you plan to pay a premium for 10 years or more, then an increasing death benefit structure can be even more powerful. Your cash value and death benefit grow together, giving you more living benefits and also help with long-term care costs in the event that you get sick. There are three key elements in understanding how you earn interest. Number one is the participation rate. Now, that's the percentage of index growth that your policy is credited with. For example, an 85% participation rate on a 10% gain, you're going to get an 8.5% return. Now, on the other hand, if you had a participation rate of 175%, then that same 10% gain gets you 17.5% return for the year. Number two are the index cap. Now, not all indexes have a cap. The cap is the maximum return that you can earn. If the cap is 10%, that's the maximum interest rate that you can earn for that period. So the way that's calculated is if the index that you've chosen turns up to have a 15% gain, you're only going to get credited with 10%. However, in a situation where there was, say, a 7% gain, well, you haven't reached the cap, so you're only going to get the 7%. Now, thirdly, and this is the big one, you have a floor in the IUL policy. Typically, most policies have a 0% floor. Now, some policies offer a bonus, a guaranteed bonus that boosts that floor up to maybe 1%, some at 2%. And what that means is that even in a negative market year, you're guaranteed not to lose any money. So if zero was your floor, then zero is your hero. Even though maybe the market loses 20%, well, you're just going to get a zero that year. So the worst case is you get a 0% return. Now, one thing that you need to watch out for is the modified endowment contract, or a MET. If you overfund the policy past the IRS limits, then you lose those tax benefits. Loans and withdrawals from a MET are taxed as income, and they may carry a penalty if you're under age 59 and a half. That's why policy design matters. When done right, a max-funded IUL stays within limits and keeps all of those tax advantages. So how does a max-funded IUL compare to just a traditional IUL? Well, max-funded IULs are built for aggressive cash accumulation. Most of the traditional IULs out there are built for protection and life insurance benefits. So those traditional IULs typically will have a higher death benefit, but also lower cash value because more of that money is going to fund the death benefit. A max funding IUL on the other hand, gives you more flexibility. You're going to have faster cash growth, and you're going to have a greater retirement income potential. And speaking of retirement, this is where max-funded IULs shine. With a properly funded IUL, your IUL can create a tax-free income stream in retirement. And think of it as your own personal pension plan. This gives you liquidity in retirement without paying income tax, without early withdrawal penalties, and without having to withdraw required minimum distributions. So now let's stack the IUL, the max-funded IUL, against the 401k. So 401k grows tax-deferred. You get that deduction when you contribute to a 401k, but then you're going to pay taxes when you withdraw those funds from your 401k. An IUL income is tax-free. So you're using after-tax dollars to fund your IUL, but when you take those distributions down the road, they're going to be income tax-free to you. Now, 401k has some strict contribution limits. IUL funding, not so much. The funding is flexible with no maximum limits as long as you stay within the IRS rules. A 401k is totally tied to the market. You ride the ups and you ride the downs, but IULs, on the other hand, you grow potentially similar to the market with no market losses. So you can increase your interest as the market grows, but when the market declines, you don't lose anything. Now, 401ks, they do require you to start taking money out at age 73, whether you want it or not. Those, on the other hand, have no RMDs. Your money comes out when you want it out. And then when you die, your 401k is going to be completely taxable to your heirs. The IUL, on the other hand, that's a death benefit. Death benefits are going to be income tax free. Fees, let's talk about that. Yes, there are costs, there are fees. Every financial tool has them. An IUL is not unique in that. But with the right structure, a max-funded IUL can minimize cost and maximize long-term value. The key to all of this is proper design, and that's where expert guidance matters the most. A max-funded IUL, it's going to be best for people that want tax-free retirement income. That's how we build these out. That's 90% of the market out there buying an IUL. That's what they're doing it for. They've already maxed out their 401k, and in most situations, our IUL clients need another place to put money, and they've exhausted their other retirement planning tools out there. They want market growth without the market risk. They want to leave a tax-free legacy. And then they value control and flexibility. Now, if that sounds like you, we should talk. I invite you to take action today. Somewhere on this page, there's a link or a button that you can click to schedule a quick 5 to 10 minute discovery call with either me or one of our licensed IUL advisors. It only takes a minute, and it could be the beginning of a smarter, safer retirement plan for you. Now, during our call, we can answer your questions and determine if the IUL strategy could be a fit for you and your family. We're here to help. Thank you for watching this. Hopefully it was helpful. Please like our video, subscribe to our channel to get updates, and share it with someone who's serious about their financial future. We're Ogletree Financial, helping you insure wisely, grow confidently, and retire tax-free. Thanks.